Hello and welcome to our next video in our IFRS 16 video series. My name's Avni Mashru. I'm a director within our UK Accounting Consulting Services team, and I'm joined today by Richard Brown, who's a member of our Global Accounting Consulting Services team. So today we're going to talk about sale and leaseback accounting under IFRS 16 and how it compares to what we have under IAS 17. We'll also be looking at how you account for sale and leaseback transactions you would previously have done under IAS 17 before the transition and what happens to those on transition to the new standard. Now we're going to be using an example, and just to let you know, in the example we've assumed that the initial sales price we're using and also the ongoing rentals are all at market value. Of course, if they weren't, you would have some further adjustments to make. So Richard, what is the accounting under IFRS 16 for sale and leaseback?
So under IFRS 16, the starting point is whether or not you actually have a sale first. So the guidance points us to IFRS 15 for whether or not you meet the definition of a sale. If you don't meet the definition of a sale, which would happen when you've not effectively passed control across to the buyer, the lessor, then you would account for it as if it's a secured loan against the asset. You'd still have the asset on balance sheet and you'd just have a new liability. Okay. So that might happen, for example, if you sold an asset but had a right to buy it back at any time below market value, you've not really transferred control. Yeah. If you have transferred control, so it is a sale and leaseback, then you'd de-recognise your original asset. You'd have a right of use asset for the proportion of the carrying amount of the right of use that you have retained.
Sounds a bit complicated there, Richard.
It is. So we'll do an example to talk through that. So let's say, for example, you have an asset on your books at 3 million. It's now worth 10 million at market value. So there's an unrealised gain there of 7 million. If you sell it and lease it back, and for simplicity, we'll say the present value of your minimum lease payments is going to be 5 million. So you're leasing it back for half the value of the building. You would say, my asset used to be worth 3 million, so my right of use is now half that. Mm-hmm. It's half of the 3 million, so it's 1.5 million. Mm-hmm. You'd then also say, at market value, this asset was worth 10 million. I've kept half of it, so I've also sold half. Mm-hmm. So I've sold an asset worth 5 million. Mm-hmm. It was on my books for 1.5, so that's a 3.5 million gain as well.
Okay, that's interesting. So if I compare that to what we have under IAS 17 today, so obviously for a sale and leaseback, you'd first of all figure out whether it's a sale and finance leaseback or a sale and operating leaseback. Assuming, say in this example, it's a sale and operating leaseback, then actually using your numbers today, you would actually get a gain of 7 million, which is the difference between the 10 million sort of fair value and the 3 million carrying value. So that's quite a difference.
That's right. So under IAS 17, you would have recognised a gain of the full 7 million on selling it, and you wouldn't have a liability at all, assuming it was an operating leaseback. Whereas under IFRS 16, it's a lot more proportional. If you have a relatively long leaseback, you have a relatively big liability and a relatively small upfront gain. It's only if you have a relatively short leaseback that you'd still get the upfront gain and a low liability.
Yeah, absolutely. That sounds interesting. So for people that perhaps had done sale and leaseback transactions primarily just for the accounting answer per se, this is looking a lot less attractive, if you like. But obviously there are still reasons that you might do sale and leaseback transactions like operational, cash flow, tax. So perhaps they're not going to go away completely. So thinking about sale and leaseback transactions that have happened prior to transition, what happens with those?
So the good news is you don't have to reassess whether or not it was a genuine sale. So the criteria at the moment are slightly different, but you won't have to go back and apply the new criteria to decide if it was a sale. If it was a sale and finance leaseback, then you'll just continue amortizing any gain and kind of carry it forward into IFRS 16. If it was a sale and operating leaseback, you'll account for it like any other operating lease on transition. So the fact that it used to be a sale and operating leaseback doesn't really matter. It's like all your other leases.
Well, that's good. That sounds relatively straightforward. Excellent. Well, that's all we have today for sale and leaseback. Hopefully you can join us again for our next video in our video series for IFRS 16. Of course, we've got lots of publications for you to find out more on both our PwC Inform website and also our website pwc.com/IFRS. And of course, if you need any further help, please feel free to reach out to your usual PwC contact. Thank you.